Your bank saying no in 2026 won't start in housing. It starts in the bond market today. High-yield spreads just jumped roughly 100 basis points from around 7.2% to 8.2%, and even 8.5% later, biggest move since the COVID fear window. That's the smoke alarm, not the S&P. Stay with me. I'll show you the two numbers to watch, yields and spreads, and why a wider gap means banks quietly throttle mortgage approvals, even if rates headline lower. If you've been staring at home prices, you're watching the wrong scoreboard. The real game? Credit availability. And it's tightening. Before we move on, please take a moment to subscribe to the channel and like the video. You've been watching mortgage rates and refreshing Zillow like it's a stock ticker. Wrong game. The two numbers that actually move your approval live off screen. Yield and spread. Your realtor won't bring them up, but your bank's credit committee does. Yield is the raw interest the bond pays. Spread is the extra interest risky borrowers pay on top of safe treasuries. Banks care because those two numbers tell them how likely they are to get burned. Your down payment is cute. Their funding cost and loss odds run the show. Here's where it gets weird. Stocks can throw a party on tariff headlines, while the bond market quietly flips the evacuation sign. When high-yield spreads widen by roughly 100 basis points, that's not vibes. That's risk being repriced. Equities cheer, but credit is the adult in the room saying, hey, the punch bowl is spiked with default risk. Which signal do lenders obey? The one that tells them what they'll earn versus what they could lose. Think of spreads like a storm surcharge on car insurance. On a sunny day, coverage is cheap. When there's a hurricane just offshore, your premium jumps even if the rain hasn't hit your street yet. In bonds, that hurricane is default risk. When spreads jump, investors demand hazard pay to lend to shakier names. That hazard pay bleeds into everything banks do because it changes the price of their raw material. Wholesale credit. We've got receipts. High-yield yields didn't just drift. They pushed from roughly 7.2% to 8.2%, then up again near 8.5%. Spreads moved to levels last seen in the early COVID scare window. Translation: investors want more money to hold anything with wobble. Banks watch that like a hawk. It's the stress gauge they use to decide if they're hunting for loans or hiding under the desk. You can already see the knock-on effects. Big financings get yanked. A leveraged loan backing the buyout of Converged Technology Solutions didn't just price softer, it was pulled. Other refis hit sludge, with lenders balking at terms that looked fine a few months ago. That's what supply tightening looks like before consumers feel it. When the pipeline clogs at the corporate end, the same caution eventually shows up in consumer lending, yours included. Use this club analogy. Bond buyers are the VIPs. When they demand a higher cover charge, the bouncers, banks, start turning folks away at the rope. First, it's the messier corporate borrowers. Then, it's the clean but not perfect homebuyer who suddenly doesn't fit the box. Nothing personal. The club is just trying to survive the night without a fight breaking out. Now connected to mortgages. When wholesale credit gets pricier and scarcer, lenders respond by shrinking their underwriting boxes. Debt-to-income caps compress. Income verification gets stricter. Exceptions dry up. That strong file you heard about last year? Today, it gets flagged for more reserves, a tighter appraisal review, or a lower loan amount. Headline mortgage rates might drift down, but if spreads are wide, approvals get stingy. Cheaper on paper, harder in real life. So here's your mini payoff. Watch yield and spread. If spreads widen while headlines scream rates are falling, banks can still say no more often, and they will. Because they lend based on risk appetite, not CNBC Chiron optimism. The realtor talks monthly payment. The bank lives in loss-adjusted return. Which brings us to the next move. If the siren is already blaring in bonds, what actually flips the switch from market stress to your loan officer ghosting your application? You think a February rate cut is your golden ticket. Here's the catch. Cheaper headline rates can land at the same time approvals get harder. Sounds backwards, right? It's not. When the pros who fund the system get nervous, banks tighten the faucet even as the sticker price drops a hair. You see lower rate. They see higher loss odds. Let's break the plumbing. Step 1. Bond buyers get skittish. They demand more compensation to hold anything with wobble. Step 2. Banks retrench. They protect capital, slow their pipelines, and get picky about who gets a seat. Step 3. Warehouse lenders, the folks who front cash to mortgage shops before loans get sold, tighten advance rates and raise haircuts. Step 4. Mortgage credit availability narrows. Same borrower, same income now faces narrower lanes and more hoops. Everyone is yelling about affordability. It's the wrong word. The real pivot is availability. Loans can be cheaper on paper, but harder to actually capture in real life. That's the joke the market plays on retail buyers. The ad says, sale. The door guy says, we're at capacity. Let that sink in. Follow the case thread. When high-yield spreads spike and leveraged loan liquidity thins, banks do the math on risk-weighted assets and hit the brakes. They trim maximum loan-to-value. They add overlays, extra rules on top of the standard guides. Think tighter debt-to-income, fewer exceptions, and more reserve requirements. They aren't being mean. They're pricing uncertainty. Here's where it snowballs. Shorter fixed terms create a refix wave. New Zealand is the cautionary tale, with a massive chunk of mortgages rolling in 2025 and 2026. When that reset collides with tighter boxes, churn stalls. People who would have refinanced get stuck. Refis die on the vine, and purchase approvals carry the extra stress because lenders have less cushion from easy refinances. Even if the Fed or the OCR cuts, the pass-through can be partial. Banks hoard margin to buffer credit risk. So the quoted rate might dip 25 basis points, but the hit to approval odds is bigger. They widen their net interest margin a touch, keep more profit per loan, and make fewer loans. You get a teaser improvement on payment and a hidden downgrade on eligibility. Non-performing loans might still look calm today. That doesn't matter. The combo of rising unemployment risk plus refix shock flips sentiment fast. Lenders close boxes before delinquencies spike. They move on probabilities, not headlines. You'll hear, "We love your file," and then see an overlay that quietly knocks you out. It's real. It's happening. Watch two tells at the consumer edge. First, the jumbo versus conforming spread. When that gap widens, risk appetite is fading at the top end. Second, overlays that appear overnight. Extra months of cash reserves, stricter appraisal reviews, and way tighter documentation for self-employed borrowers. That's the credit freeze in plain sight. Rates eased, but the hallway narrowed. So here's the thing. If high-yield spreads stay elevated into 2026, prepare for a mortgage drought. Not just fewer yeses, harsher terms on the yeses you do get. New build pipelines start stalling because developers can't lock financing on sane terms. Pre-sales don't clear, construction loans linger, and local inventory that should arrive in late 2026 never breaks ground. That doesn't mean you tap out. It means you read the field, track spreads, and yield. Watch the jumbo gap. Ask your lender if overlays changed this week, not last month. Time your application before the warehouse guys crank down the advance rates.